Right, I think we're good to go. So I guess I'll start with the formal bits. Welcome everyone, thank you for your time. For those of you who don't know me, I am a co-founder at 3Search. We're a digital and marketing recruiter. I've worked with the panelists on and off for the last 10 years for some of you. So it's a real pleasure to get everyone together, which is great. And yeah, the less talking I do and the more talking they do, I think is the recipe. So I'll pass over and let the guys introduce themselves and we'll get into it from there. But the broad topic is all around FinTech. It's something that I've spent the last 10 years in my recruitment career talking a lot about and listening to lots of, I guess, FinTech stories. And I thought it was a really interesting topic to start with. So yeah, let's kick off and over to Jasper.
Hi, I'm Jasper Martens. I am the Chief Marketing Officer at PensionBee, an online pension manager. And I've joined PensionBee in 2015. So one of the first employees. And before that, I was the head of marketing and communications at insurance provider Simply Business.
Over to you, Jen.
Good morning, everyone. I'm Jennifer Vickers and I work at Octopus. Octopus is a group of companies. You may know our largest business in terms of customers, which is Octopus Energy. We're a renewable energy household and business supplier. Or you might know our largest business in terms of contribution, which is Octopus Investments, where we look after just over 9 billion of investors' money. My background is a bit varied and I guess I got to where I am today, which is the brand and marketing director at Octopus, through a lot of work in mergers and acquisitions, post-merger integration, and a lot of work thinking about how you stitch different company brands, different company technology, different company data sets together when one company buys another one, and what that means for the staff and the customers and the suppliers.
Thank you very much. John?
Hi, I'm John Woods. I've spent some time at Barclays, 5 years in FX trading with IPOing CMC markets, some time at Samsung and splattered in between there. I've spent a good amount of time at startups, which is what I'm currently doing, where I recently joined Zenus Bank as their CMO. We are yet to launch. We are licensed out of Puerto Rico, which is actually license enable people to open an account from anywhere in the world.
Very good. Last but not least.
Good afternoon. It's a pleasure to be here. I'm Ellie Sherwin, Head of Marketing for EMEA at Silicon Valley Bank. And Silicon Valley Bank is the only bank in the world focused exclusively on serving innovation companies. And that includes around 1,500 FinTech clients, hence why I'm on the panel today. I've been at SVB for over 10 years now, aging myself, and have a background working in marketing and PR for startups, VCs, and most notably 3i, the private equity firm.
Great, thank you all very much. Right, so let's get straight into it. The first, as I mentioned in our intro, we've already had a question, which is where we're going to start. And I'm going to go to you, Jen, in terms of, I think, given the world that we're living in at the moment and what's going on around us, I'd love to hear your view on the relationship between FinTech businesses and funding and how that's working at the moment. Given the Octopus link, I'm sure the attendees will be really interested to hear your view, and then open up to the panel and start a discussion around FinTech and funding, because I think it's a really interesting place to start.
Awesome. So I guess working at Octopus, I have the ability to see the funding relationship on both sides of the way I see it, both sides of the seesaw, because I see Octopus Ventures obviously working very hard to deploy investors' money into small businesses, and FinTech and the future of money is one of our key areas of focus for investment. But I also see Octopus Investments working very hard to raise money to deploy, and that's money from retail investors and also from kind of very large institutional investors, and actually that whole spectrum in between that can include everything from discretionary fund managers, wealth managers, family offices, private banks, etc. So I think if you look at both sides of that seesaw, I think the money in is obviously where a lot of spotlight is looking at now. Are institutional investors still investing the same amount? Are they still making the same asset allocations to kind of smaller companies and startups and entrepreneurs that perhaps they were in a pre-COVID world? Retail investors, have they got the sorts of disposable incomes to make these type of investments? Are they still got the same appetite for risk? Does a VCT or another kind of tax efficient structure like an EIS or something like that still work for them? So I think there's a lot more attention at the moment on the actual raising of investment rather than on the deployment side. I think on the deployment side, those that still have the appetite to invest are still very open to a broad diversification of underlying sectors. We personally invest mainly in a kind of health tech, FinTech, and really kind of deep tech and quantum computing. So I think for those investors who still want to make that commitment to smaller companies and to startups and to entrepreneurs, FinTech is absolutely a really viable option. But I would just question whether there is still that same level of investment appetite there at all, both on the retail and the institutional investment side.
That's really interesting. Just something that you said, Jasper, when we spoke last week around you're on the other side of the fence from what you were saying, are looking to raise at the moment. Just give us your perspective and what you're seeing in the current climate around the relationship with funding.
I guess when it comes to funding, I guess the question that probably will be asked more and more is, what is the business model a profitable one? How are you going to actually increase your revenue? How are you going to make a profit? Now, with PensionBee, we've always had that model around, we've had that at the forefront when we started PensionBee back in 2015. But I guess if you look around in the FinTech ecosphere, there are quite a lot of companies who have solely focused on growth at any cost. And I think those companies probably will get more questions around, okay, so, but how are you actually making how do you making a revenue on a particular customer you acquire at a particular cost? Because in the end, you can't just burn money on keep growing at any cost. And I think I wouldn't say COVID is the main cause. I think COVID has been the trigger, because economically we're probably looking at a more dire times ahead. But I would say pre-COVID, the sky sometimes was the limit, and I sometimes was looking at it from a, wow, that's a very interesting take on investing.
You must have had some interesting conversations, Ellie, with funding or what you've seen with some of your businesses that you're working with. What are you seeing in terms of a trend, building on what Jasper just said around maybe profitability or cost per acquisition of customers? That must be a really interesting time from a relationship with the business that you work for.
Yeah, definitely. And I think that what we're seeing is a lot of investors doubling down on their portfolio companies, and we did see a bit of a drop in funding in Q2 just generally, but there are mega rounds going on and lots of investment going into companies like Onfido, Thought Machine, Checkout.com, others that we've seen, and that's really, really positive. And so from our perspective at SVB, we're really bullish, right, about the future of the industry. But of course, we'd like to see some of the smaller companies getting funded. I also think that in this environment with COVID and Brexit and some of the government schemes, which are government relief schemes, which are coming to an end, that's putting almost every company in the world, right, under a really extreme amount of pressure for an extended period of time. So I think it's still quite early, right, to see how all of this is going to be playing out, and a lot of companies and FinTechs will be concerned about their growth, access to capital, talent, etc.
I think what VC investors are looking for, that hasn't massively changed. So if I ask one of my investment teams 2 years ago, what do you really look for? Which are the FinTech companies that you're going to back, versus now, which are the ones you're going to back? I really love Jasper's point about people looking a bit more at profitability rather than just scalability. But I think some of the other factors, like, is it game changing and disruptive? Does it have a competitive edge? Is there a really big market opportunity? And is it ultimately tech enabled and sort of hardwired to scale at some point? I think those factors were probably the sort of tick list of VC investors a couple of years ago, and they're still the factors now. And actually one of those, which is it an enormous market opportunity? I think that's probably, there's more of that now, because with change and with different frames of reference and with sort of big social upheaval comes enormous market opportunity that perhaps wasn't there before. So I don't think, although it's perhaps a slightly challenging message on is the investment going to come in from the retail and institutional investors perspective, I think actually, are there the right businesses to invest in? I think we should be really positive about what times like this can do for the pipeline of opportunity.
Yeah, and I would just build on that as well, Jen, because I think it's such a good point. And we can't forget that fintechs are really incredibly broad church. And so what I wouldn't want to do is paint the entire sector with a broad brush. And there are definitely some verticals which are, you know, potentially untapped at the moment / still ripe for disruption. And so there is time and space for other players to come in or smaller players to come in and disrupt and grab some of that market share.
As well, I think especially if businesses have got experienced management teams, and we're seeing as an investor a lot of almost serial entrepreneurs, serial startup management teams absolutely grabbing this kind of current macroeconomic time to start new businesses and repeat what they've done in the past. Those will inevitably be successful, because if you've succeeded in previously challenging and complex times, you probably are going to succeed again. So those companies will inevitably be fought over for funding, because once you've got that track record as an entrepreneur, not as an investor, but as a track record, you carry that with you for the rest of your career.
And I think turning this unprecedented times into a positive, actually unprecedented times might actually mean the best ideas are born right now. So it's probably, like you're right, Jennifer, if you've got an experienced team behind it and you actually can clearly demonstrate that there's a need, then there's always money available to fund that idea. And I really hope that will continue to happen.
Yeah, I mean, certainly, as we spoke before, that there's been a change in the view on how businesses are to spin the carousel and get it moving as fast as possible and get it out to market. Whereas now I think there's much more of a view on the unit economics and actually looking at the revenue lines and looking at scale. And we spoke about it before, but the markets and the money that is out there to invest, there's not a huge number of other places that are doing great returns at the moment. There's not high interest rates. The central banks don't actually want to be taking money. So funds need to be looking for places to put this cash to make it return. So there is an appetite, there is the volume of money out there, is an appetite to invest it, but I think people have been more prudent on where backing serial entrepreneurs who have performed before as well.
So that previous track record, I'm hearing from all of you, really is something that you think potential investors will look for. Is there anything? Maybe this is a tough question because none of us have got crystal balls, and we would probably all be very wealthy if we knew the answer to this. But is there anything that you think, looking forward, the next few months, years, do you see a theme of, we've seen open banking explode, for example. Is there anything, new? What's the next thing off the block? If that is even a question to try and answer now.
I think, one of the things.
Sorry, I was going to say, the one that's coming up a lot is property technology, which surprisingly, with a property market that's maybe less stable and changing very much with the changing use of retail, it's an industry that is now looking to have to make much better margins. So there's a lot of opportunity in that space for introducing new technology and more direct plays. So I think property tech is a market that people will be watching quite closely.
Go on, Jasper.
I think two things really, there's definitely, we are more worried about our own health these days. And I think health tech is definitely an area, and maybe Jennifer, you might have some more flavor and information about that, but that's definitely something that probably will boom. But overall in FinTech, I think some of the things that were already happening, I think that they might accelerate. So for example, lots of new FinTech propositions and companies who are really relying on that online relationship have really invested in that online relationship through multiple devices, etc., not relying on branches, etc. And I think in that sense, they might actually have benefited from the situation where we were actually locked into our homes and we were relying on that online connection. So I think you've mentioned open banking. There might be some other initiatives that just might accelerate PensionBee. We just released a report with Plate on bringing pensions into open banking. That's just been an acceleration of something that was in the pipeline, which is, you know, the need for this is more clear than ever.
I think in times of real challenge and complexity and uncertainty, you can go right back to I'm really sorry if this is misquoted, I think it's Benjamin Franklin who said the only things that are certain are death and taxes. And we are seeing so many proposals in the tax space, so in FinTech, but in tax management, because at times when you potentially your any capital that you have got is being eroded because of the real value of money, to pick up on the point that John made about potential negative interest rates, or disposable incomes being squeezed, and we're not seeing kind of real rises in wages versus potentially the kind of economic climate. That's something that people look at. They look at their tax exposures, they look at the tax exposures on their savings, their income, their pensions. So not the sexiest or glamorous of areas, but I think technology and innovation in tax management, both in the platform and also in the propositions that we see from financial services providers, is definitely going to be a trend.
Right, interesting.
Yeah, and I would say, obviously being the banker on the call as well, that I think banking as a service, we are definitely going to see more happening in that space, and there's a need for more flexibility, more scalable banking infrastructure, etc. Same with FX and digital remittance, where there are some big players in there, but I think there's definitely some space for more.
Really interesting. So let me move the conversation forward. The last financial crash for me was, or certainly where I saw the birth and rise of a lot of these fintech brands, and the demand for, or the kind of easy sell again, I guess, was, we'll look at the big bad machine who's caused all this problem, and it was a very easy way for I guess trust was broken, and then there was a lot of new entrants based on customer trust and the demand for people wanting something different. So I just want to, certainly starting with you, Jasper, with the work you've done as I guess a challenge or a new entrant into a fintech market. Do you think that the current situation will have a positive impact on consumer trust, or a negative impact on trust, and how can we use that as fintech professionals, or how can you use that to kind of build your brand, I guess, is the question.
I guess the current crisis at the moment is not caused by banks or any financial vehicle in the first place. It's caused by a virus that we just have to deal with right now. I think that's a big distinction between the two. So although a lot of great ideas were about new financial products or companies were born out of the financial crisis, as in like, look, this is how the way they did it, let's not do it this way, let's do it differently. I guess that, of course, won't really be the case. I would say one of the things that is being really noticeable for financial companies during this COVID crisis was the trust, like building trust. Like we know it's more than it's really important, but actually it was really important. There's still companies who don't pick up the phone since lockdown. They still have unprecedented levels of inquiries. How is that even possible? So I think that's what consumers are asking. And guess what? More traditional players are playing that ball, that card about not picking up the phone after 7 months of COVID. While certain other companies, and I think like I've seen some of the challenger banks actually really stepping up. They were available on the phones, on live chat from day one. They've actually helped customers more and better and quicker than some of the traditional companies. So I think how companies have behaved during the lockdown and during this COVID crisis, I think that's what people will judge them on moving forward. So I think that's really one of the things that I've seen. And some of the newer fintech players. So if you offer a really bona fide product, you have an FSCS guarantee, and you're backed by, for example, big investment managers or investors, then customers, you are able to keep that trust and build that trust. So I think that trust factor thing for me was a really important thing to see, where you would think some of the bigger, more traditional companies would really, you know, ooze trust, and this is where we need to get to. Let's abandon my challenger bank and let's go to the traditional one. Actually, the traditional one doesn't pick up the phone after 7 months. So I don't trust them. I might as well stay with my challenger. So I think that's one of the things I think I've really seen. And new players and new companies, new propositions tend to be more online than offline, which tend to be really in favor of them now rather than what was happening in 2008. We are used to managing our finance on our phones, not necessarily in 2008. So I haven't seen a branch in 2 years from the inside. So I guess a lot of people might have favored the online propositions. And like I said, in 2008, it was the financial services meltdown. Now it's a virus. So it's very different from that back then.
Just before I go to any of the other panelists on this, you talked about one of the things, you know, I've obviously, you know, because I've followed, you know, we've worked together before, and I've seen the PensionBee journey, especially over the last 2 years or 18 months. You've been very visible, you know, with above the line spend and you know, TV and out of home and stuff. As a marketer or a CMO, what do you have to think about pressing pause on that sort of thing during this time, or is it been, you know, building on the trust point, I guess, is, you know, do you want to be seen to be out there advertising to win customers at the moment, or are you having to be quite careful?
No, I think we don't have to be careful at all. We've got a solution for a lot of UK pension savers, and we are actually solving their retirement problem, their pension problem. That's what PensionBee is about. We combine your pensions. In lockdown, actually, you get a bit bored after a while, don't you? So you open up the drawer and voila, there's your pension paperwork. So actually, it was good. However, it was very challenging, simply because when people are raiding the shelves of toilet paper and pasta, they are thinking about their short-term needs. They're not thinking about anything more long-term. Retirement, in that sense, is way down the priority list. But after we start to see that appetite coming back after a few weeks, we actually restarted TV, we restarted radio. And the economics about acquiring our customers, knowing how much it actually costs, then it turned into our favor. So I would say the challenge of a company like PensionBee was, because we are still flexible and agile enough to kind of like cancel an outdoor campaign in April because nobody was on the street, moving that spend onto TV, where I could negotiate a good deal with some of the networks directly because lots of advertisers weren't advertising. Making those decisions instantly. I always talk about, I'm riding the COVID-19 wave as it comes, and you just have to adapt and on that situation. So challenging, yes, absolutely, but actually a really it's been a really good surf so far. Like, yes, ups and downs, but just take it as it comes.
Yeah, fascinating.
I think there's a real difference in B2B and B2C customers, because I think Jasper's talked a lot there about B2C, right? You're talking about man on the street and how they're responding. I think that in the B2B world, it's a bit, nobody got fired for choosing IBM. And I think B2B buyers, I think, will behave quite differently to B2C buyers, because I think if anybody's going to retreat back to your more traditional brands and away from a sort of FinTech proposition that feels quite different, it's somebody in a business capacity rather than a personal capacity, because jobs are vulnerable, companies are vulnerable, and I do think there is a bit of a backbone of nobody got fired for choosing Aviva.
True. And I think one of the things that did really come up, and then I'm just talking again on the D2C side, which we are, more queries came in. We got 3 times the number of calls coming in and live chats. And one of the most asked questions was, what happens if you guys are going out of business? Like that, there's no denying about that. That happened. You know, when you explain to them that it's 100% FSCS guaranteed and that the funds are with BlackRock or State Street Global Advisors or the biggest, like the things that how we've built it, that reassured. But there's no denying that those were the questions asked. And you're absolutely right. Aviva is less likely to go under than PensionBee in one of these downturns. So that's a challenge, and that's what if fintechs really need to answer. Like, have they got this again? Have they got the solid trust factors behind them? Because if not, people will start to question. We saw it with the annual reports, the results from like some challenger banks being published. Instantly, people were jumping on it, like, oh, look at that footnote in the report. See, they might actually only last 18 months. So I might want to move banks. You wouldn't ask that question with Lloyds per se so quickly.
Especially, I think, in a B2B capacity, when you have due diligence processes anyway, you have all these kind of robust onboarding processes anyway. Those decisions are not generally emotional. They're driven by internal business procurement process that's much more likely to be designed to be a defensive business play rather than a progressive, aggressive business play.
Yeah. I think an interesting, Andy, back to your original question, I was at Barclays during the last downturn, and I think my feeling for that was the banks had lost the trust long before then. When they started centralizing all their operations, they took the manager out of the heart of the community. It used to be a privileged position to be the bank manager. So the banks eroded that part. And I think what you're seeing now with Canary Wharf being shut down and people being put back into the communities, I think companies are realizing that you do have to have a greater connection with your audience, with your customer base, and be that consumer or be that B2B. They want to see your face, even if you are online. You know, you still have to be there and you have to be available, and that might be through Zoom or other channels. But I think people are looking for more confidence signals, and that kind of comes from the trust in the community and being visible and active. And looking at now, I think in 6 months are from this as to how they've behaved, because again, back at Barclays, when there was foot and mouth, Barclays was the only bank that went in and lended to farmers that were having all their cows put down, and that goodwill lasted for a decade. And I think actually out of this, the ones that have done well and have gone above and beyond expectations could really come out very beneficially in trust and kudos from that.
That's a really interesting point.
Yeah, I think that's such a great point. And a lot of this has also been about making sure that you don't come across as tone deaf to your customers either, right? So you're with them, you're walking in their shoes, you're empathetic of the situation that they're in. And I know for us that's helped us to build more client advocacy actually through this time, where maybe through a Voice of Client program, whatever, you might see that dropping down because companies are under extreme levels of stress. Actually, there's an opportunity to build that advocacy. I'd also say that more of the customer journey nowadays it's been forced to be done online. So where you might be more of an offline player traditionally, you know, a lot of companies have been forced to really try and accelerate as quickly as they can, or put plans in place to accelerate as quickly as they can their digital experiences. And that's really challenging for those with, you know, antiquated systems.
It's going back to John's point, is that, yeah, a whole digital transformation is going on, but the demand for a personal kind of touch point is, and I see that with some of the roles we're recruiting and as a customer as well. So it's really, really interesting. So something when we got our heads together last week that came up, and building on something that Jasper just said then about, I guess, security, is the impact of a fintech business having some additional backing or some additional, well, yes, whether it's tobacco or some serious funding behind it. And obviously with you on the call, Ellie, I just wanted to pick up with you around, you know, the different types of fintech and the different, you know, how the market might react or how the customer might react, knowing that you've got, you know, a big business or a big bank or whatever behind you. Just offer some insight on that, if you don't mind.
Yeah, sure, happy to. And actually, I'd start by picking up on a point that Jasper made around, you know, the regulation and actually and consumer trust. Because I think that the fact that UK FinTechs are regulated by the FCA in nearly all cases, and that FCA logo being really clearly highlighted on their platform is such a massive vote of trust in consumer eyes. So I don't think we can lose sight of that. And I think that, you know, you'd probably rarely find the average consumer go then hunting and looking for, all right, well, who is TransferWise backed by InvestorWise or whatever, as an example. But there's no doubt that established businesses are probably at an advantage in terms of the fact that they've got access to capital, talent, customer advocacy. They tend to have obviously deeper pockets, and therefore they've got larger marketing budgets, which is tremendously helpful as they're trying to build their brands and think about customer acquisition, etc. And that's really hard for true startups to compete with. They just, you know, they might be able to sustain it for a short period of time, but they probably can't sustain that kind of customer acquisition for an extended period of time. But having said that, I do think that there's opportunities for new players to come through, whether or not they have that institutional backing or not. But it's kind of going back to where we started some of the discussion about, you know, have they got the breakthrough idea? You know, have they got a clear strategy? Is there a market for what they're trying to develop? And we would love to see more of those startups getting that kind of backing and being able to disrupt. And I really think that, and I think about SVB's role in this as well, right? And I think now is, you know, an even more important time than ever for companies like ours to be really doubling down and supporting the government schemes and, you know, some of the regulatory, because we're really advanced on that front in the UK as well, to really help those companies grow and thrive and become big and meaningful businesses. So a long way of saying, I think established companies are at a distinct advantage, but there is opportunities for, you know, smaller ones to come through and to attract that investment. But it is just going to be a bit more challenging as we see how the situation plays out.
And just building on something that we talked about earlier, or seemed to be mentioned, do you think, again, as the banker, as you said, do you think that there will continue to be this appetite for, you know, these businesses that will make big, you know, continue to make losses, and there's no sign of profit, and they're trading on reputation or potential, I guess? Do you think that this will change that, or do you think this is just merely a kind of blip in the road, and you know, we'll see a return to relative normality soon enough?
Yeah, I think that I think you'll see investors focusing more on the portfolio companies that we have versus perhaps taking risks on ticket items with smaller and new companies. It's also really hard in this environment for small companies to make those introductions, and they're all learning just like us how to use Zoom, how to pitch in a virtual environment and get that traction. So I think that these mega rounds and some of the consolidation in the market is probably likely to continue. But I don't doubt that, you know, in the future we'll get back to a place where there's opportunity for investors to start looking at some of those startups again.
I think there's a real head and heart way of looking at this. So there is no doubt that there is a balance sheet, spreadsheet, numerical assessment you can make of a fintech or a startup that's got the sort of associations or backings or investors of bigger companies or more established companies or companies with much stronger or with more financial stability. There's also a completely emotional side, which is the heart side of, as a consumer, and I think this is more in the B2C space, if I can see an association of a company with a brand that I just believe to be a more established, more stable, more long-term company, either in the example that Jasper gave, which is actually, well, you know what, these funds are, you know, they're underwritten or they're provided by actually big company X, or we look like a fintech, but actually we're 80% owned by very well-known insurance or pension fund Y. I think that gives consumers confidence. And that might not be because they think those brands are absolutely brilliant. I don't think loads of B2C customers think that, you know, BlackRock is an absolutely, fantastic company, but they've heard of it. They know it's just this big behemoth institution that's probably not going to go anywhere. And I think it's all completely emotional, but I do think it does a job for the fintechs. And so they shouldn't shy away from those associations in a way that perhaps they might have done before this. But it's not a spreadsheet balance sheet thing. It's a completely irrational, emotional thing.
I think the piece they very much wanted to step away from was the cultural ties. That's the thing about being a startup or doing things your own. You can approach, and that's the thing about not wanting to be associated with that traditional, slow, methodical, timely route to market. But getting that balance now where you actually can have the backing and the credibility of the money and the stability, but still have the dynamic nature of being a smaller company and having your own culture. I think that's the really nice balance to strike.
Jennifer, I can totally confirm that our customers are not like super excited when they see BlackRock. You're absolutely right. Like, it's just one of those things. However, they do associate BlackRock with a really large skyscraper somewhere in America with a lot of money, and it's the largest money manager in the world. So yes, I guess so. John, also on your point, I think you just have to cherry pick which elements of that brand or that backing is relevant for your startup. So the fact that we bank with Silicon Valley Bank, for example, we've actually used that from the start. Do you know that, Ellie? But yeah, it's kind of like those things. You need to cherry pick which elements of the companies you work with are worth building that trust for. So when State Street Global Advisors took is the largest the largest external shareholder of PensionBee, they took that in, I think, December 2018. That went into the FT, and that really we saw the conversion rate improving. We just saw that instantly overnight. People think, oh, okay, so actually this big company that, you know, I have no idea what they're doing, but they're big and they have lots of money. They believe in this company, so that must be good, right? And exactly, and that's how I guess you can definitely use the backing of such a large company, and almost like replicate the trust that a large company normally offers.
That's really interesting. Okay, so the final point I want to discuss, and we'll do this and hopefully have some time for Q&A. So if you're listening and you've got any questions for the panelists, please start to type them in, and we'll get to as many as we can if we have time. But the last point, linking it back to, we can't, I don't think, do a session like this and not talk about careers and whether that's people looking for jobs or out of work. And I guess I've spent 10, 11 years talking to people who have looked at the, you know, sexier side of the street in terms of, you know, oh, I work at a big bank and I now want to go and work at Monzo or Starling or, you know, any of these businesses. Really interesting. I've recruited for all four of you, and you all work for different businesses of different size and scale. But I want to just have an interesting conversation around what the current climate's going to mean for careers within fintech, and how, if you are a startup, you know, sexy brand with no money and a table tennis table, does that mean you lose out to, you know, a more established business where a pension or a healthcare provider is more important now than it was ever before? So over to you, John, something that I thought, you know, I think you've got some interesting views on.
Yeah, I've always viewed this in sort of seeing people fall into three general camps, which is around money. So are they going to get paid over the average wage for doing the role? I've never really been field that played in that they can pay over the odds to get people in. And the counter to that is that there may be people looking for a brand, as you said, sort of a sexy brand, but they're attracted by that business being highly visible and doing interesting things in the marketing space. And the third camp is people looking for a unique experience. And that could be through the market just being brand new. It could be through the project just being super exciting. Or it could just be a passion project for them, that it's something that they're really, really passionate about personally, and that's a greater attraction. So you kind of, I kind of look at it like a Venn diagram and see, okay, you've got a really strong brand, the money, and is it, and as a candidate, you kind of look at it and say, well, obviously I want a job that sits right in the middle of that spectrum of being, okay, visibility and money, but also good experience. And then I look at the other side as being a recruiter and think, okay, well, if I'm in a big company that can afford to pay over the odds, I'll dial that side up because I know we're not a very sexy brand, or our project isn't very interesting, and I'm going to have to index higher there to get somebody in. Whereas if you are on the other side, you can play to some of those other aspects a bit more. And I think the reality is, the recruiter is, you just have to be aware of what your limitations. Believe that you get to do that role at that time. So yeah, it's a difficult one. I mean, I've recruited in big companies, and you get a lot of people coming through the door, but they're not very passionate about the jobs necessarily. And you can be in smaller companies where the people don't have the same level of skill, but they're just so much more willing. And it's that, you know, will versus skill. You can get some great people, but probably like a mid-table Premier League team, you know that someone bigger is going to come in and take them off you a little bit further down the line. And you just want to get the best years out of them that you can.
I love that analogy. I just building on your point around the passion projects and also being aware of your strengths. So I love the points that you made, John. We're hiring really aggressively at the moment, which is amazing, especially given this environment. But our observations are that actually we're increasingly seeing candidates motivated by other factors, especially if you think about millennials and Gen Z, which are obviously starting to come through the ranks. And you know, yes, they want to be paid well and they want to work for a really sexy brand, but they also are starting to ask more questions and care more about things like purpose and ethical stance and our company values and, you know, career development opportunities. And I don't think that that's a trend that we're going to see going away. And we might see more cross-pollination and a transfer of talent between the legacy players and upstart fintechs and things. But I think that the aforementioned things will remain really important for people. But the legacy players are obviously going to have to work pretty hard as well to make sure that they can attract some of those younger generations who are digital natives and don't want to, again, be working on antiquated systems either.
I think that poses a really big challenge for management teams, right? Because if you're in a time right now and potentially your business is not as profitable as it was, potentially one could argue to run a business well, you need to focus on one or two things. Are you going to focus on protecting what you have? Are you going to focus on trying to maximize a possible growth opportunity that comes from disrupted times? Are you going to focus on recruitment and hiring? Are you going to focus on taking a defensive position with the people and the market share that you have? It's impossible to do all four of those things, you know, et cetera, et cetera. So I think it's quite a tough time to run a business that's not super big right now, because you won't have the resource, the time, the money, the people to do everything. And it's almost like, you know, rolling red and black in a casino as to what's going to be the big bet that not just protects your business through an economic downturn, but potentially sets you up for growth coming out of it as well. And that might be people, but it might not always be investment in people.
The really interesting that's different now in my mind is that before, the job market it seemed a very closed, dark place, that if you're unemployed, you were just off the pitch, you were just unavailable, unseen. Whereas now you can be on Upwork, you can be getting small jobs, you can be contracting. And actually as a recruiter or as a business, you can be taking these people on a much more project basis. And as skilled resource becomes available in the market, you can tap into some absolutely fantastic people and some views and get what you. I don't know that we've had that in the workplace before, because of the digitization of that you know, HR side of things. I think it's an interesting dynamic we're going to have going forward.
What we've seen is, because we're currently hiring as well at PensionBee, we're hiring amongst our own customers, which is also something that, you know, would you have thought about that a couple of years ago automatically? We've got quite a lot of customers now that are having the right skill sets needed to do particular roles at PensionBee, and actually recruiting people who believe in the product, believe in the brand, but also believe, like what Ellie says, the company values is increasingly more important. To give you another example, we are launching a fossil fuel free pension plan in the next 2 weeks or so. So we've actually had quite a lot of people applying for roles who picked up on that and say, actually, I really like the direction you're as a company is going into. Some people actually came from, they still are in the job. They're actually employed by like bigger pension companies. The other point I want to make is a lot of larger pension companies and banks are actually shedding people at the moment. So it's not like they are like the safe havens they always used to be. They are going through a process of more efficiency savings, closing branches. So a lot of people will, like, they're not as safe as you think they are. They actually might shed more people than some of the newcomers. So this is another point, an observation I've seen. I think TSB is closing 160 branches in the next year or so. Like, they're shedding people, they're not hiring more people.
It's really interesting. I think that what I'm seeing, or what I've seen over the last 2 or 3 years of talking to a lot of candidates, as you might imagine, I think the point that Ellie's made around an employer with a purpose is going to be more prevalent than ever before. I just think, you know, the days of kind of people selling their, you know, going to work and just picking up a paycheck at the end of the month is, from everything I'm hearing and everything that people are telling me that they want, those days are numbered, I think. And businesses who, you know, perhaps some of the traditional large faceless businesses, or that's a bit unfair, but you know what I mean, the perceived larger businesses who don't have a clear employee value proposition, or aren't clear on what their purpose is, I think they've got to work really hard over the next few years to attract top talent. Otherwise, you know, some of the smaller, more nimble players will be able to snap up good people, as John says. So that's just my view on it anyway. Anyone else with anything to add? Because we've got a question that I'd like to open up to you. So the question's from Natalie Burrows. So thank you, Natalie. We've spoken about the up and coming tech, prop tech, health tech, tax management. And we said that within digital transformation, we can't lose the human touch. So with that in mind, what do you see as the specific priorities, for banks, insurers, and utilities businesses as we come to the end of 2020 and enter 2021? So any specific priorities? So would anyone like to pick up on that?
Yeah, AI, artificial intelligence, is the moment across all of those channels that if you want to do anything at scale and you want to be delivering these personal experiences and having an understanding, everything has to be built around artificial intelligence and machine learning. So I think it's just endless what you can do with that technology at scale. And for the bigger businesses, that's where the focus is really going to be, is actually getting in systems and processes built around AI and machine learning that can scale and deliver that personalized approach and responses to people.
I think there's a more human answer as well. I think companies have got to understand their customer journeys much more, because they're never going to see their customers now. Maybe they didn't anyway, but that's a growing reality. And many customer journeys for many businesses are still a mix of on and offline. They involve potentially an element of personal contact. They involve potentially still some paper. They involve increasingly a number of online touch points. But I think there are very few companies who have a real grasp on their end-to-end customer journey, both for new business, but also for servicing and kind of post-sale life cycle management. And across all of those sectors, and I'm fortunate, I work at Octopus, we're in a number of different sectors. That is the one thing we're desperately trying to get a grip on, which is all the different touch points our customers have, in what order, in what channels. So we can maybe then look at some of the innovations and the investments that John was just hinting at. But until you know every place your customer is met by you, impossible to make those investments smartly, I think.
I couldn't agree with you more on that point, Jen, and just getting so much smarter about using data and making it about the client's journey or the end user's journey versus the experience that we think that they should have and that we've cookie cutted for them based on personas as marketers, etc. And being able to predict those moments that matter for them, especially at the moment. in when they're having a really, really difficult time. And that we're even thinking about small things like, you know, someone's having, or not so small things, life events, like, you know, a client's wife is about to have a baby, or, you know, they're just about to close their round of fundraising. And how can we internally get much smarter about knowing when those moments are going to happen, recognize them, be there for them, and then support them through that journey?
So largely, I absolutely, I think automation, artificial intelligence, data, they're all really good things, I guess, to scale up and without losing the human touch. The problem that you will often find is that a lot of companies then will lose the human touch still after even doing all of that. So they might export their call center to to another provider, or even outside of the country, or provide really poor customer service or non-personalized. So I think, you know, if we are using technology and we are using AI and we are using a profound data set and deep insight, understanding the customer journey, let's then just don't forget why you're doing it for. And, you know, it's ultimately that person on the other end, that is your customer. That's what you're making your money off. That's how you exist. So then don't scrimp on that and outsource it to somewhere else, or, you know, put people on it that are only motivated by how many calls they do in an hour rather than actually helping a customer. So way too often you see that. That's been my bugbear.
I also think the key question the key word in Natalie's question is, what do you think the banks, insurance, utilities, whatever, will prioritize? Because I think businesses are not brilliant at prioritizing, especially those in the growth phase. So especially those startups, those scale-ups, those fintechs we've been talking about. I think sometimes ambition can override really well-controlled prioritization and areas of focus. So if there was ever a trigger to take the tough calls as management on what are going to be your one or two big growth bets, where you're really going to focus your people, your money, your time, your best, your best skills and your best talent, then I think that in itself might be a bit of a trend, because I don't think we've seen enough prioritization across businesses in the past few years. I think businesses have been complacent and fortunate enough to be able to try and do everything.
I think that's right. And one of those priorities has to be delivering on your brand promise, right? And so there are basic things as well. So if part of your brand promise is about delivering insights to your clients, then you have to find a way to do that online, whether that be through basic things like webinars like we're doing today, and just really finding your place so that you are delivering on those things and not almost using this virtual world as an excuse not to get in front of clients.
It's really interesting because just summarizing, I guess it's from what you've all said, you wonder whether actually, you know, on the face of it, fintech businesses might look like they're struggling because they're, you know, they don't have the funding, or the funding might dry up. But everything you're saying that I'm hearing is personalization, human touch, you know, doing things with a purpose. And those smaller, nimble, you know, easier to kind of pivot type organizations are likely to be, you know, if you work at a big multinational bank, are you going to be able to roll something out or move as quickly as if you work for, you know, PensionBee or whoever, you know, another small, you know, fintech who can pivot and react quickly? You wonder actually whether the financial crisis or a financial crisis might play into their hands rather than not after all this. So yeah, really interesting. Okay, look, well, I won't do anything else because I'm conscious of everyone's time, so I'll wrap up. But thank you all for attending, and thanks to the panelists. Really interesting, really insightful, and we're going to do a few more of these over the next few weeks. So yeah, keep an eye out, and really appreciate it. So thank you all for your time, and see you soon.
Thanks, folks. Bye.
Cheers.
Bye.
Thank you.